What's up, everybody? It's Johnny, and I'm back today to talk about rising interest rates and its impact on money. In today's video, I am going to break it all down. As always, to keep things clear, concise, and easy to follow, I'm breaking this video down into two parts. In part one, I will explain what is going on right now in the economy by defining the relationship between inflation and interest rates. In part two, I will talk about how rising interest rates impact the housing market, businesses, and more. Before I dive into all that, I want to take a second and say thank you for watching. And if you have not done so already, please click that subscribe button. Thank you so much. All right, here we go. Let's get into it. Part one, what is currently happening in the economy and what is the relationship between inflation and interest rates? We are currently experiencing a period of very high inflation, and the government is working to fix that. Inflation is defined as a general increase in prices and fall in the purchasing value of money. So what does that mean? Let's take a real-life example. Think about the prices of items in the past versus the prices of the same exact item today. A Big Mac meal from McDonald's in the 1980s cost around $2. Today, that same meal costs around $6. Don't get me started on gas prices. We can all compare gas prices from a year ago to today. That is a hot topic. Aside from fast food and gas, everything seems to be more expensive right now. What we are seeing is accelerated inflation. Governments are highly aware of this and actively work to regulate it. So the question is, what causes inflation and why does this happen? Specifically, we've had a lot going on in our lives and in the economy over the last few years. There are a plethora of reasons for why inflation has increased at too high of a rate. One reason could be because of the pandemic caused shortages. Supply chain issues have occurred, which have made it harder to transport goods around the market, and this impacts pricing. Other reasons include climbing oil and gas prices, corporations continuously raising the prices of goods each year, and stimulus packages. Remember all of those stimulus checks, PPP loans, EIDL loans? Some argue that the government might have put too much money into circulation and it caused overspending. Some argue the rise in inflation is just a part of the normal economic cycle. At the end of the day, there are many reasons, and anyone can speculate on which is the direct cause and which cause is most responsible. Regardless, this is where we are. We are experiencing a time of high inflation. The government's job is to regulate this and protect the economy. A way to reduce inflation is to raise interest rates. So we are entering into part two of the video. How do rising interest rates impact money? First, let's dive into what an interest rate is. If you borrow money, you have to pay back extra to make it worthwhile for the lender. That extra is the interest rate. So if you take out a loan, you want a low interest rate. There is no single interest rate in the economy, and all the different banks set their own commercial rates. However, all commercial rates are influenced and impacted by the central bank rate. A central bank is a bank for banks. Banks earn interest when they leave money with a central bank. Commercial banks have reserves, that is their cash on hand. They lend excess reserves to each other and have the ability to deposit excess with the central bank and earn an interest rate. When the central bank raises the interest rate, they are trying to control inflation. When this happens, it impacts consumer spending, consumer confidence, employment, and investments. Higher interest rates reduce consumer confidence and slow consumer spending. Businesses have a harder time borrowing money and investing in their product, which results in less economic activity. This can impact businesses' profitability and in turn cause layoffs and reduce employment. If employment is lower, there is less spending from consumers. In normal circumstances, if interest rates are higher, the value of homes typically decrease. This makes people feel less wealthy, which in turn results in lower disposable income and lower spending. Ultimately, higher interest rates slow down spending. This impacts investments and slows down all economic activity. Businesses cannot raise prices, and this should, as a result, reduce the inflation. So the question is, how high will interest rates go? There is a time lag between the raising of interest rates and the reduction in inflation. Where we currently sit is in a very difficult time. Prices are still high and interest rates are rising. In tough economic times, it is so important to budget, save money, and spend appropriately. Please check out my other videos on how to save money and how to budget. I will be back soon with another video. Thank you again for watching, and remember to click that subscribe button if you have not done so already. Have a great day.